Hey everyone, welcome back to Corporate Decoder, where we make corporate filings easy to understand. Today we're diving into Eva Live Inc's latest filing, and boy oh boy do we have some numbers to dissect. Get ready for a roller coaster. So what's the big news? Well, Eva Live Inc is looking to raise some serious cash with an offering of units, each unit containing a share of common stock and a warrant to buy another share. They're aiming for $4.12.5 per unit. This offering is all about getting more money to grow the company. They plan to use the funds for acquisitions, research and development salaries and other expenses. It's a classic move for a company looking to expand aggressively. Now, before we get too excited about their growth plans, we absolutely have to talk about the risks. Companies like this always have a long list of things that could go wrong, and Eva Live is no different. They are upfront about needing more money. They say they may need to obtain additional financing, which may not be available. They also have a limited history of operations, meaning they don't have a long track record to show they can be successful over time, a common hurdle for newer companies hoping to make it big. This is a big deal. When a company's auditor mentions doubt about its ability to continue as a going concern, it's like a flashing red light saying they might not be around for much longer without a serious cash infusion. It signals that the company's current resources might not be enough to cover its debts and operating costs for the next year. For Eva Live, this doubt is linked to their significant accumulated deficits and negative cash flows from operations. Their top 3 customers made up 88% of their receivables as of June 30, 2025. This means a huge chunk of their money comes from just a few clients, putting them in a very vulnerable position. If one of these big clients decides to cut back or leave, the company could face big problems with its income and overall financial health. Let's talk about the money. As of June 30, 2025, Eva Live had about $261,079 in cash. That might sound like a lot, but remember they have significant debts and operational costs. They also have accumulated deficits of over $23 million. Looking at their balance sheet as of June 30, 2025, we see total assets of about $9.1 million. On the other side of the coin, their liabilities are around $2.9 million. This leaves them with stockholders' equity deficit of about $6.1 million. So while they have assets, their liabilities and past losses mean they are still in a negative equity position. Now for the actual business performance. For the 3 months ending June 30, 2025, Eva Live reported revenue of over $4.1 million. That's a jump from the same period last year when they had around $2.6 million, a huge turnaround from a net loss of over $360,000 in the previous year. The trend seems to be positive as the 6-month period ending June 30, 2025 shows revenues of over $7.8 million and a net income of over $4.6 million. That's up from a net loss in the prior year. This suggests their strategy might be starting to feel off. We need to keep an eye on those big customer dependencies and the overall going concern issue. After this offering, they expect their cash to jump significantly and their total capitalization to go from about $9.1 million to over $13.6 million. That's a good boost, but it comes after selling more shares, which means more dilution for existing shareholders. And speaking of dilution, investors in this offering will experience immediate and substantial dilution. This means that the value of what they're buying now will be worth less per share than what existing shareholders paid, based on the book value. They are essentially paying full price for their shares, while the value per share for new investors will be much lower than the offering price. It's a common scenario in IPOs, but still important for investors to understand. Looking at executive compensation, David Boulette, their CEO, earned over $7 million in 2023 and about $3 million in 2024. This compensation is largely in the form of stock awards, which is normal for executives aiming to align their interests with shareholders. However, it's a substantial amount and highlights the incentive structures in place. Then who's in charge? Well, David Boulette, their CEO, holds a significant number of shares, holding over 19 million shares, which is about 60.70% of the company. This means he has a controlling stake and can heavily influence major decisions. This concentration of power is a key factor when considering the company's direction and its responsiveness to other shareholders. We also see related party transactions, especially with Hottest Media LLC, which acts as the company's agent for buying media traffic. This is common, but it's crucial to ensure these transactions are fair and transparent for all parties involved. The AdFlare acquisition also involved Phil Aspin, who is both a co-founder of AdFlare and a board member of Eva Live. These interconnected roles need careful oversight. The warrants being offered alongside the stock are speculative. They give holders the right to buy stock at a certain price in the future. They can be valuable if the stock price goes up, but they also carry risk. There's no established market for them yet, and their value is tied directly to the company's future stock performance. The underwriters Maxim Group LLC are taking a 7% cut on this deal, plus they get their own warrants. This is standard practice in the investment banking world. The company is aiming to list on NASDAQ, which is a big step up from the OTCQB market. Success here would lend a lot more credibility and potentially liquidity to their stock. Let's look closer at the numbers. As of June 30, 2025, their cash is $6,179. Accounts receivable is a massive $8.7 million. That's a lot of money owed to them, which is good, but also risky if some of it can't be collected. Their furniture, fixtures, and equipment are really minimal at just the $32.92. On the operations side, their revenue for the 6 months ended June 30, 2025 is $7.8 million, a significant increase from $4.4 million in the prior year. The net income for this period is over $4.6 million, which is a massive leap from a near break-even situation last year. In terms of equity as of June 30, 2025, they have a deficit of over $23 million. This means their liabilities and accumulated losses exceed their assets. However, the equity has improved significantly from a deficit of over $24 million at March 31, 2025. Cash flow from operating activities is tricky. For the 6 months ending June 30, 2025, they used about $2,300 in cash for operations, which is surprisingly low considering their income or deficit. Cash flow from financing activities shows they received over $189,000 this period, mainly from new notes. The company's core business is using AI to match advertising campaigns with ad spots. They leverage big data to optimize ad performance. They operate in the digital marketing and media monetization space. Their typical customers are advertising agencies and businesses looking to market products. The Eva platform is their main product. Going back to the audited numbers as of December 31, 2024, their cash was only $763.56. Their accounts receivable was over $4 million. Liabilities were about $2.5 million. And they had a stockholders deficit of over $1.5 million. And they had a stockholders deficit of over $1.5 million. The picture here is more challenging than the unaudited June figures. For the full year 2023, revenues were about $5 million with a net loss of over $6.6 million. In 2024, revenues jumped to over $5 million. Wait, that's not right. Looking at 24, it was $93 million in revenue, but they still had a net loss of $3.75 million. So revenue is up, but they are still losing money. Cash flow from operating activities in 2024 shows they used over $1.1 million in cash. Investing activities used a small amount, and financing activities provided a significant $715,000, mostly from new notes. So they're burning cash but managing to get funding. They follow US generally accepted accounting principles, or GAAP. For revenue recognition, they have a principle-based model where they buy media and sell it to clients, recognizing the total ad spend as revenue. This is a key detail as it means they control the entire process. Again, the going concern issue is highlighted here. They have recurring losses and negative cash flows and rely on further funding. Their accumulated deficit is over $28 million as of December 31, 2024. It's a race against time to get profitable and sustainable. They've capitalized software development costs with a useful life of 3 years. Interestingly, as of December 31, 2024, there's no unamortized balance, meaning the software is fully depreciated or expensed. This could mean they are either past the main development phase or the original capitalization was limited. Their furniture and fixtures are minimal at just over $6,000 by the end of 2024. They purchased more in 2025, but it's still a tiny part of their assets. This signals a lean operational setup. They've taken on convertible notes and term loans. In April and May of 2024, for example, they secured convertible notes totaling $300,000 with a purchase price of $240,000 after discounts. These notes are being settled by issuing shares, which is common but does add to dilution. The company underwent a 4-to-1 reverse stock split in February 2025. This is often done to boost share price and meet exchange listing requirements. They've also issued a lot of unregistered securities over the years for services and consultants, indicating transactions outside of normal market sales. Looking at past warrants, they sold units with common stock and warrants where the warrants had an exercise price of $8 and a term of 1 year. Many of these have expired or been unexercised. The new offering has warrants, but their terms are subject to the offering price. They have several outstanding convertible notes and term loans. The interest rates are generally around 12% for the convertible notes and 6% for term loans. Some notes are being settled by issuing shares, highlighting a strategy to manage debt through equity. They have specific policies for revenue recognition, and they judge whether they are acting as a principal or an agent. In the principal-based model, they take the full ad spend as revenue. In the agency-based model, they earn a platform fee. Currently, all revenue is from the principal-based model, which is a more direct and potentially profitable approach when it works well. The auditors allow professional state that the financial statements present fairly, but they also reiterate the substantial doubt about the company's ability to continue as a going concern. This is a critical warning sign that investors need to pay close attention to. They mention that the company's ability to continue depends on obtaining additional working capital funding. So what's the takeaway here? Eva Live Inc. is in a growth phase, trying to scale up its AI-driven advertising platform. The unaudited financials show promising revenue and income growth, but the audited figures and the auditor's opinion paint a more cautious picture, especially regarding their going concern status and reliance on a few key customers. Their strategy of using AI and big data is sound, but execution and securing consistent funding are paramount. Now for my take. The company is clearly trying to reposition itself with the offering and NASDAQ listing, hoping to gain credibility and access to more capital. The revenue growth is encouraging, but the high customer concentration and the auditor's going concern warning are significant risks. Warren Buffett would tell you to be very careful here. He'd look at the lack of a long track record, the high customer dependency, and the need for constant funding. While the technology sounds promising, the immediate financial health and sustainability are questionable. The company is making progress, but it's a high-risk, high-reward situation. Alright, that's our deep dive into Eva Live Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.